Please have them contact me and we'll arrange for you to get a slide deck in here and you'll have 5 minutes to share with this group. And because this group is comprised of 175 people now, but more importantly, with the fine work of Steve Maltz, these are video recorded and edited, and then we post these up on YouTube on the internet where they're visible to anybody in the world to see your particular project or fund. So if you want to share some information about what you're doing, please let me know. We'll give you an opportunity to do that. So that break at that point. Again, my name is Karl Dakin, and we're going to talk tonight. The focus of tonight's program is on setting up one or more Opportunity Zone funds that are focused on Colorado small businesses. So at this point in time, we have one fund, 4 Points Fund out of Steamboat Springs in Colorado, that is got a small business Opportunity Zone fund for rural communities. But as far as I know, all other funds in the state at this time are either dedicated single purpose funds or they're single project funds. They may be a multi-asset, but they're very narrow focused. There isn't a general, let's go here. There's no gap fillers. There's nothing out there at the moment. So after talking with a lot of people at conferences across the state over the last couple of weeks, it seemed like now might be the right time to create one or more funds here in Colorado. And so I have started putting together all the documents to make this happen. This is part of an outreach to try to find partners who would like to participate in putting the fund together, potentially helping manage the fund or be involved with the fund at some point. So in this part, I'm going to talk about some of the issues that have led to this point. Then in part 3, I'm going to talk about the actual mechanics or structure of the fund as it's now being proposed. And then in part 4, I'm going to talk about some options on either a second fund or a different structure of a fund that is using the same basic model that I'm using, because there are several ways to go about doing this, and mine clearly won't fit all the situations that I know of, but I think it's the first best next step forward. So to begin with, Manufacturer's Edge was at the Economic Development Council of Colorado's conference last week, and they stated there was about 50,000 businesses in Colorado who are what they call second tier or maturing businesses. These are the ones that a lot of economic developers look to hang their hat on because they have the chance to grow and create jobs of a significant amount. Now, these may include the unicorns and the gazelles and all that. There's, in this large of a population, it's likely that we might see 10 or 20 very, very fast-growing, large-growing businesses over time. But even so, here in Colorado, where the average business has less than 15 employees, we have over 250,000 small businesses that have at least 2 employees. So they're not solo, they're not sole proprietorships. And we have a large number of businesses that have only 1 employee or a part-time person or something along that line. Since I'm involved in a number of these that fall in this category, I'm reluctant to count these because I have 4 or 5 or 6, 7, 8 businesses that are in this category, and I'm involved in about 6 or 7 at this tier, and I'm hoping that some of the businesses I'm working with are in this larger category. My company, Dakin Capital, I'm planning to launch this fund. If everything comes together, I may launch the capital raise for this fund as early as November 1st, 2 weeks from now. I've been through the drill enough with so many different projects and acting as an advisor to the Invest New Mexico Fund. A lot of these documents have been designed and tested and so on. So we're that's not the issue. It really gets down to some of the actual structural elements. I want to design this so it's attractive to investors, and at the same time, it gets the job of helping out small businesses. So if anybody's interested in participating in this fund in any manner, any form, whether it's to help raise the money, receive the money, put the pieces together, be an advisor, as I'll explain what that means as we go through this, please let me know, contact me, because I'm going to try to get this thing off the ground here very quickly. In this case, we're focusing on small businesses, not on property developers. So most of the Opportunity Zone funds to date have invested into development of a property, whether it's a single family, multifamily, or large complex of some kind, shopping center or something else, hotels, whatever. They've been in that line. They're not really focused on the businesses. If the businesses are included, they're incidental or secondary to the property development. If they're investing in an Opportunity Zone business, it's to do the development. It's not for some other purpose. And so all the businesses which are also capable, who are in an Opportunity Zone, really don't have a choice yet on where to get funding for their particular business. So we're going to focus on that. The fund needs to get the word out. So I'm going to be setting up systems within this group, within my business and the other businesses I'm associated with. I'm going to be working with local and state government agencies and different programs, various entrepreneur programs, social media, and the press to get the word out so everybody knows about this. But any small business who's in this state who's looking for funding should support this effort, because it's in their self-interest to get the word out about this fund, and it may enable them, in effect, to get funded by this fund if they do it, they play their cards correctly. So one of the things we're going to do in this fund that you won't see in other funds is we're going to set up a skills training program on how to raise capital. So it's going to be like a boot camp. The principals in the company who are selected to receive the benefits from this fund are going to go through an educational program and learn the skills about how to understand what their capital needs are, the capital sources that are available, who is more likely to invest than not, how to structure a deal, how to put this into material that clearly communicates the business effectively, and where to place those messages in order to make their campaign quicker, faster, more effective in getting to the market. And this will be one of the benefits of being selected as a business to receive funding out of this fund. The next thing we're going to do is we're going to set up a matchmaking platform. Right now, we're looking to essentially license an off-the-shelf white label platform that has a matching functionality built into it. And what we're going to do is set it up so that if you want to try to find a source of money, a type of money, or in-kind resource that you need, this would allow you to match it. So if you get funding through the Opportunity Zone, you also have the ability to go out and find a grant or a gift or a USDA loan or a co-PACE funding or Jumpstart funding or any of the other things that I know about, but very few people know any significant portion of those, and nobody knows them all. It's a never-ending task to try to identify every source of, that's out there. So we're going to try to create something that makes it easier to match. It's going to have a lot of detail that they're going to have to drop in so that we're getting direct one-on-one matches instead of false negatives and saying, yeah, you matched up criteria-wise, but there's no way you're going to put the money in. So we want to be better on that end of it. So these two programs will be over in addition to the primary program. So that ends part 2 of tonight's program. And I'm going to, in the next section, I'll be talking about the actual mechanics of this fund, how it works, how it pays back investors, and a number of the many decision points that had to be reached in order to figure out how to do this particular fund, which is not locked in yet. So if I get a lot of feedback from certain people, they want to make some changes in this, then I'll have an opportunity to make those changes before we launch. Take a break here. And I will be making a presentation in this section on tonight's topic, which is setting up a new Opportunity Zone Fund specifically for small businesses within the state of Colorado. This model, as I've mentioned in prior presentations, is taking advantage of some of the work I've already done for Invest New Mexico, a similar fund that has been created and is currently raising funding to help small businesses in the state of New Mexico. It's also drawing upon a large amount of experience over a few decades on raising money from multiple sources and having tried to design local funds and community funds and special purpose funds that can get the job done without getting bogged down in one of many issues that can kill a fund or make it dysfunctional. So first thing we're going to do in this particular fund is we're going to set it up as a limited liability company. In past programs we've talked about, you've got basically two choices here, or three, however you want to look at it. You have a corporate structure where the money is captured inside of the fund and it is not taxed, it's taxed as a corporation. The other choice is do a partnership or limited liability company where ordinary income is passing through to the fund, and this creates a need to distribute the ordinary income throughout the 10-year life of the Opportunity Zone investment, and it's going to be taxed. So it has the disadvantage of being taxed. It has the benefit of providing capital to pay your Opportunity Zone taxes when they come due in 2026. So there's some give and take like there is in most of the choices that you're going to find in setting up a brand new Opportunity Zone fund. And the second thing, the question is, who are we going to raise money from? And in this case, we're going to set this up so that we can raise money from both accredited and non-accredited investors. And this may change because in order to do this in the fullest sense, then I would have to do something equivalent to a Reg A filing for crowdfunding in order to be able to raise money at the federal level. If I do it at the state level, then I'd have to fall under the Colorado Crowdfunding Act or under a limited registration offering in order to offer this to both groups without constraint or restriction. Now, a lot of the funds I've worked with, and including the first one we set up in New Mexico, was a 506C offering under Regulation D of the United States Securities and Exchange Act. And it limits investments only to accredited investors. And again, as we've talked in this program, accredited investors are a limited group of high wealth people who have the ability to invest with lesser restriction because of securities laws. And some of them have securities, capital gains, some don't, but there's a lot of non-accredited investors who make up about 97% of the population who also have capital gains, and we'd like for them to be able to participate in this particular project. So if I go to the federal level, I could technically raise up to $50 million. At the state level, using this approach, I can raise up to $2 million. And so I'll have to think about which direction I'm going to go, and it may change the size dollar volume of what I do. Or if it becomes too much of an issue, in going that route, I can go back to a 506C and publicize the offering and continue forward without the restrictions on promotion. Next thing in this is I want to limit investment to citizens, correct term is residents of the state of Colorado. This allows me to work solely within the securities laws of Colorado without having to conform or deal with other restrictions and constraints on raising money that are imposed at the federal level that are not necessarily present here. As an example I gave a moment ago, if I do an intrastate crowdfunding program, I can approach this in one fashion where if I go to the federal level, I've got a lot more paperwork that I have to create, and it's going to cost a lot more money to put this whole thing together. So at the current time, I'm not looking to raise money from outside the state. and that may become a challenge for me to get all the money I want to do here. But for the moment, that's where I'm leaning. Right now, the minimum size of this fund would be $50,000, and I'll explain where that number came from in a moment. For the moment, I've set it at $25 million on the max side. Depending upon which type of security law or pigeonhole I want to fall into, I may have to drop this dollar amount, and as a practical matter, I may not be able to expand all the $25 million. As you know, an Opportunity Zone fund, once it receives the cash into its hands from an investor, has a fixed period of time in which it has to deploy that particular money. It's generally described as 6 months, 180 days, from when they receive the money from the investor to when they have to put the money to work by investing it directly into a property or into a qualified Opportunity Zone business. Now, with the recent rules that have been presented in April, you actually have a little bit extra time from when you first create the fund. So if I were to receive money now, I wouldn't have to invest it till June 30th of next year. So that there's a little bit of a factor there on first dollars into the fund. Once that fund's in operation, then we're at the 6-month time period no matter what. But this, when you raise money into a fund, a critical element is, can you put the money to work within the time period in which you receive it? So I have the ability to receive money now, and I have the first 6 months of next year in order to put that to work. So I can raise money now and not have to do it by December 31st. That gives me more flexibility. Next thing is I'm looking at a minimum investment size of $5,000 and a maximum of $25 million. So if any of you in the crowd tonight have $25 million, can help me close this fund immediately, please let me know, and we'll take care of that, and we'll move on to the next fund. But the lower amount is a dollar amount that some people can't afford. Clearly, the majority of the population, $5,000 is going to be too much. So this isn't the same level as an accredited investor, the top 3%, but here we're probably looking at top third of the population may have an ability to put up $5,000 without stressing their budget or putting the money at risk that should go elsewhere. The other 2/3 wouldn't really fit into this. So if we're going to do additional funds in the future, one of the things we may change is trying to drop this dollar amount down to something where anyone who has a capital gain can participate. Obviously, the lower income you are, the less likely that you have a capital gain that you can roll over, or it would be appropriate for you to invest in something of this investment structure for a 10-year hold. So one of the things we're doing here is I'm creating what's called a Funders Fund. And I say called a Funders Fund because that's what I'm calling it, and I don't know what else to call it, and there is no name for it. But each business that is selected to receive funding from this fund is going to get a maximum of $50,000, and it's going to be deployed specifically for the single reason of going out and raising more money. So a lot of time businesses come to me and they say, I need to raise $100,000, $500,000, $5 million, whatever, and they don't have actually a budget to run a capital campaign. They don't have the time to be on the road, the travel, to put together the promotional materials, to go out and meet with investors, to even get their books in order and other things that are needed in order to do that. So based upon a lot of work in this area, right now I'm using a $50,000 maximum investment in any particular business, and it's going to be dedicated to raising more money into that business. And the money has to be spent within some very tight controls, meaning we're not going to have a business show up and we're just going to hand them a check for $50,000. They have to come to us with a team or go to people we have pre-qualified who will work with them during this campaign to make sure it runs right and runs well and has a high probability of success. Unfortunately, nearly all small businesses have little or no skill in raising money, and therefore they struggle at it when they do it and often are unsuccessful. And we want to remove as much of that risk factor as possible by teaming that small business with experts who can help make this all happen. Then what will happen is it's expected that the business will go out and raise money, and upon successfully raising money, it will pay a fee back to the fund of $60,000. So those who are the mathematicians in the audience tonight will be able to determine that that's a $10,000 profit to the fund for helping them with their capital campaign and walking them through that particular cycle. In addition to that, or I missed a slide. Oh, it's in this slide. Got ahead of myself. I thought I'd broken this part. In addition, we're going to ask each of these funds is going to give us $60,000 of equity in that business. So they're going to pay a $60,000 cash fee and a $60,000 equity investment for supporting them and going out and raising money. So this is a return that comes back into the fund for the investors who have put up the original money into the fund. Yep.
The stipulations around that equity, I mean, in terms of, is the framework already built for what they have to do for that equity, 60K equity? What you get for that, any rules?
Yeah.
How you structure that is going to be standard? Or
typically, you're going to take the equity in the same form that they're going to do their capital raise in. So if they're going to do a corporation common stock offering, we're going to participate at the same level as the investors. We're not going to get it at a discount. We're not going to get a special deal. We're not going to get preferred stock. We're not going to do any of that. We're going to position ourselves in the same position any investor in that business would be, whatever that raise happens to be. The raise doesn't, when the business goes out to raise money, it doesn't have to be equity. It could be debt. It could be going after a grant or something of that nature, in which case then we would have to come up with a new equity structure for this particular offering. So if, for example, Ron was going to pursue an SBIR grant from USDA, is that correct agency? He may come to us and go, I want to go after this grant. $50,000 may be the right amount to get everything ready to apply for a grant that could be $500,000 to $900,000. What's the?
Depends on which phase you're in.
Which phase? Well, I'm phase one.
Phase one, less than that. May not work for that.
May not work for that. Good point. So this won't work for everything.
Okay.
Okay. But it may be something when we get the application, that makes sense to us. So we're going to work out a deal for Ron with equity. We're going to work out something where he pays us back somewhere down the road. He can't pay us back out of the grant because it won't allow us to do that. But he'll have a debt obligation to us for that amount of cash, and he'll give us some equity in his company.
For phase two, almost like the SBIR phase two.
Right. So we may do something where we roll it over into a second grant, which cascades into a phase two with more money and more value along the way. But it could be a loan. The business could say, I'm going after a massive loan for a construction loan for a large project. We'll help put it together, all the paperwork, and then we get paid back out of the loan proceeds as a cost of origination, or we're a line item in the loan, so we get paid back. And then the second part of this is we would participate at the same rate of whatever loan that is. It creates revenue back into the fund.
Have you specifically thought about USDA loan type stuff in your thinking here?
Yeah.
Okay.
Yeah, there's some things that will not work here, either because of size or cost of money, and there will be a delta there. So again, I'll talk about that here in just a second. We anticipate that each business that we support will be in a position to complete successfully its capital campaign within 6 months and be in a position to pay the fund back. And again, this is an average. There'll be certain projects that run faster, some will run longer, but for modeling purposes for the fund, we're looking for money to be put out into work and within 6 months to get that money back, and then to put it to work again, so that we're rolling this over during the entire 10-year term of this particular fund. So, so from an investor standpoint, each time we go through this cycle of giving support to a business to go raise more money, we are projecting on average we'll get $10,000 of money back above our cost. So this will be ordinary income. Within the framework, we're only going to distribute through 2,500 or 25% of that money to our investors. So they're going to have a tax liability on the 10 grand, that their share of this money, and we're going to pass through enough to cover their taxes in almost every situation. Some people will be at lower tax brackets, so they'll have some net cash coming to them, but we recognize that during the 10-year cycle, there may be 10 different K1s coming out of this partnership style tax structure, and we want to make sure that we're distributing enough cash throughout the term so that they don't find themselves upside down on taxes from year to year. The $50,000 that is basically a return of our investment is going to be rolled over into new projects. So again, by model, what we're looking to do is put $50,000 to work, get $60,000 cash back. $10,000 of that is income. We can use $7,500 of it, but we have to distribute at least $2,500 of that $10,000 to the investors to cover their taxes. So we'll have $50,000 plus $7,500 that we can roll into new projects. So technically, this entity has the ability to grow where year over year, you're going to have approximately a 30% growth rate within the scope of the fund in its ability to put money into more projects. Now, the $60,000 that's received in equity will be held and sold when appropriate. So this may be a sale that occurs during the 10-year time period. It may be something we don't have any choice over. The company is acquired and our stock has to be sold along with everybody's else. We get cashed out. It may be something that we arrange with the business to make sure there's a sale at the end of the 10-year time period, so there is a liquidation point and we can cash out the investors. If we get the money back during the 10-year time period, we're going to roll it over and put it back to work in other investments of the same style. So just depending upon how much gain is here, how much this will contribute to the overall growth of the fund. So each $50,000 invested in the fund may result in supporting 20 Colorado small businesses during the 10-year time of this. So it's every 6 months, $50,000 goes out, comes back, we reinvest it, and so twice a year, we should be able to put this money to work to help 2 businesses in over 10 years. That's 20 businesses, again, for the mathematicians who are with us tonight. So let's talk about where this fits best. We probably will not accept a proposal from any business that's going to result in them raising less than $500,000 in whatever form. If you take our fee of $60,000 plus $60,000 in equity, that's $120,000 total value on a $500,000 raise. Now we're talking over 20% cost of just to obtain the money, not counting the cost of the money itself. Now, in certain cases, I know people are going to ask us to do this, even though it's expensive, even at this rate. Now, if you drop down to a $5 million offering, then we've gone from a 20% down to about a 2 to 3% administrative cost of raising the money, which is far less than a broker fee if you could get a broker to do the raise. The cost of money will be over the top of that, whatever they give up in equity or interest or something else. But their true cost, total cost of money, both gaining it and using it, will, at this level, should be very competitive. And for businesses between these 2 points who don't have a lot of other options, we expect will remain competitive through most of this area. So there are some things that won't work if they don't hit a minimum here. Fine, they can raise more than this. We don't have any issue with that. but we're thinking that this is the what they call the gap, where people can't get funding from other sources. We're going to try to fill that gap as best we can. Because we're using $50,000 increments, it means we can spread the investments over a much, much larger number of small businesses, so we can have a greater impact on the number of businesses that are benefited. And we're not getting hung up on a single investment or a small investment. So we have a much more balanced portfolio from an investment standpoint compared to a $5 million fund that invests in 4 or 5 businesses, and they're out of money, so they're only impacting 4 or 5 businesses. And at the same time, there's a potential that one failure will cause the entire fund to go upside down or return a negative ROI. And now, if you think about this from a multiplier standpoint, every $50,000 into the fund has a chance to be used 20 times to raise a minimum of $500,000. So we're talking about getting up to $20 million raised with our assistance on the low end, and on the high end, we could be talking as much as $200 million, where we have been an active agent, a catalyst to make this funding available. And we're not just putting the money to work, we're matching that with both educational training to improve the skills of the entrepreneur, to allow them to leverage this money potentially several times more with other types of funding, and we're going to try to help match them with those other types of money, so there's a higher probability that they will get that money and create a variety of capital stacks over time, which will all work to give them the capital they need to start and grow. So this is the direction that we're going with this. So at this point, before getting to the next slide, do any of you have any questions about the different elements of this fund and the direction we're going?
Is this going to be limited to opportunity zone areas?
Yeah, the businesses in this case have to meet the qualification to be an opportunity zone business. And so yes, they have to have a 70% of their business activity has to be within an opportunity zone fund in terms of either acquisition of assets and putting them to use, or employment, payroll, things of that particular nature. So this fund will not be supporting businesses that are outside of a zone. And if this works well, obviously we would have the option to do other funds that are not focused on opportunity zones. And we still have the ability to do other funds that might do matching money or greater amounts of money or team with other people. And this fund can syndicate with any other opportunity zone fund where it makes sense, where we may already have people who are going, once your people get through this boot camp and they've got all their stuff together, we're standing ready to put money into these because they're now ready to receive money. The biggest challenge that most small businesses have is that they're not seen. No one knows where they're at, doesn't know who they are, and they're invisible to the source of money. The second biggest thing they have is they're not ready to receive the money because they don't know how to structure their deal, they don't know how to present themselves, and they don't appear credible enough to compete with all the other businesses who've done more work. And so at the end of the day, they fall to the bottom of the choice list. And so we're going to try to address both of those issues, both visibility and preparedness, to make an investment into that particular small business. And again, what we would like to see is over 20 years, we would like to raise enough money into this fund and put it to work, knowing that occasionally a business is going to fall down. And right now, we're going to be using about a 10% failure rate. So 1 in 10 raises will fail to raise enough money to pay us back. Any other questions at this point?
I'm still stuck a little bit over the administrative aspects of this $60,000 of equity that you get in these companies, and you know the term sheets around this, and just in terms of a refusal, this matching aspect of what this you don't have preferred with the common stock. And I'm not experienced in this regard. So just trying to. It seems complicated to me. of not having your own terms and the reporting requirements, and I guess, you know, if they go and raise capital outside of the Opportunity Zone money, I guess, you know, maybe you don't care about that. But
No, actually, we would encourage them to raise money from any source. So the thing is, you're anticipating this business needs to get ready to raise money from someone. And they're going to raise money from all possible sources. And they may or may not be pointed towards the best source or the lowest cost of money or something. But they're going to have to do something to get ready. And in that, they're going to have to structure a deal, which may be equity or debt or something else. That all has to be done. And if they haven't done it yet, then this is part of what this money goes to help them put it together. They need a promissory note, they need a convertible note, they need a common memorandum of offering, they need all the agreements to go with it. Do they need a website? Do they need to put together, you know, flashcards or pitch decks? All those things are there. And then actually, how do they communicate that? How do they push their message through the channel to the targeted audience? So we're going to help them work through all those things. And the 50,000, you know, at the end of the day, we're not going to hold them to the 50. It's going to be like cost plus 20 type of a model, and that will go for the equity as well, meaning we can impact more businesses if we're under that amount. But we're using that as an average. But yeah, anytime we're looking for getting something back from the company, they're going to go raise that from someone else. And the biggest problems that have arisen is when somebody comes in at this stage and says, well, I want the stock at half the price that you're going to sell it to the public at, or I want a special deal, I want priority rights, or like a venture capitalist, I want march-in rights and take this away. No, we're gonna try to structure the deal to be sold. We want to participate alongside the investors, which gives credibility, you know, that we're not getting a special deal and we're going to get paid first and they never get paid. So we're not going to take a whole lot of stock and we're not going to do it. We're just simply building value. So you can see a $50,000 investment. Technically, if we're successful, we'll get the $10,000 plus another $60,000. We're getting $70,000 over and above our $50,000 investment over some period of time. And if that stock goes up in value, then we're fine. And we know we're going to have losses along the way. No one is perfect, and the crystal balls don't all work. But my experience has been that a properly prepared business, pointing in the right direction with all the tools and with people to help them through this, has a high probability of getting the funding. And it isn't a forever job. It's something where here's who you need to talk to, here's what you need to say, here's your deal structure, this should work for you. If they come in the door and it doesn't look like we can get there, they're not going to meet our initial criteria. But once we get there, this isn't that complicated. We have our agreement with them, which is to basically, we're going to give you this resource and here's the strings attached. You have to do all these things. You have to complete the boot camp. You have to do these other things. Or there could be penalties, or we could just pull the plug on this whole thing and say we're not going to do it. There's really no reason for a person to back out unless somebody comes along with a bigger check, in which case we're okay with that. They reimburse us and we'll just move on. So they'll have a buyout capability in there. And we're basically going to be running large volume. This is not one where I'm worried every moment this particular business is going to fail, because I want to spread this out over a whole bunch of businesses. Any other question? Yeah, Ron.
As you get investments, is it going to be difficult to account for deploying that particular investment within the time frame? Do these all have to be segmented, or can it be pooled?
It's a good question, because I'm probably going to make a modification in this structure for that very reason that you're asking. We're probably going to make the fund a pass-through vehicle, and we're going to create essentially a project management new company over the top of this. And once we move the money from the fund to the project management company, it has 31 months to deploy that funding. So that gives us a lot of elbow room to do this, because in our minds we'd like to deploy all the money immediately, and we're just subject to the constraints of size and people and so forth. Yeah, initially it looked like it would be simpler to go directly from the fund, but it does hit the time clock. Any money we'd raise here would have to be invested by June 30th of next year. And if we raise more than a little money, that will become problematic. Even if we're really, really good at what we're doing, it'll still be hard to get. But if I spread it out over 31 months, that's not going to be an issue. And technically, we want to put it to work as soon as possible anyway, but I don't want to be crowded into making poor choices or less selective in our business process to find those businesses. Any other questions? Okay.